My topic is Keystone pricing in detail explain, and let's go to the topic and let's go to the start. Keystone pricing is a pricing method in which all merchandise is marked up by twice the wholesale cost. A retailer may initially establish Keystone pricing for products in the store, and then they may later decide to mark down items that haven't sold quickly. Keep reading for more details on what Keystone pricing is and how you can use it for your business. The Keystone pricing method marks up all merchandise by double the wholesale price, the price paid by the business to the vendor for the product. For a business that isn't sure how to price a product, Keystone pricing provides an easy starting point that is likely to ensure some profit. Keystone pricing is a retail pricing strategy in which the price of a product is set at double the cost of producing it or purchasing it. This means that the price of the product is marked up by 100%, allowing the retailer to make a profit of 50% on each sale. For example, if a retailer purchases an item for $10, they would sell it for $20 using Keystone pricing. This pricing strategy is commonly used in industries such as fashion, jewelry, and home goods. Keystone pricing is a popular pricing strategy because it provides a simple way for retailers to calculate the selling price of their products. However, it may not be appropriate for all industries or products. For example, in highly competitive markets, retailers may need to adjust their pricing strategy to compete with other sellers. Additionally, Keystone pricing may not be suitable for products with high production or sourcing costs. Ultimately, retailers should carefully evaluate their costs, competition, and market demand when choosing a pricing strategy. Keystone pricing is an old strategy that dates back to before everyone had computers. Calculating specific pricing and profit margins required that complicated equations were calculated by hand, and not everyone had the time, or math skills, to do that for every item. If everything was priced at the Keystone, on the other hand, you could calculate risk from discounts or sales or offers with greater efficiency. Margins and markups. Margins can be expressed by both percentages and dollars. Either way, they represent the amount of money the retailer makes for every sale. The starting point for these margins is the initial markup, IMU. Markup is the difference between the cost of the product and what you sell it for, its market price. The initial markup is a sort of best-case scenario for what you hope to make for a product. Keystone pricing is a way of trying to ensure that this IMU earns you profit. Keystone pricing is a pricing strategy in which merchandise is marked up by exactly twice the wholesale price. Here's how to calculate it. That looks a little too simple to be useful, but the entire benefit of this pricing strategy is its simplicity. A Keystone markup gives you a rule of thumb pricing strategy that, in most cases, will bring you a favorable gross margin. Keystone pricing has its origins in pre-computer times. The effort and information it took to calculate the optimal price of an item was too great to do manually for the average retail business without access to modern computational power. Doubling the wholesale cost allowed retailers to take into account fixed and variable costs, such as coupons, theft, returns, and other common margin eaters while still turning a profit. They should also consider the unique features and benefits of their products, as well as any promotional or seasonal factors that may affect sales. In some cases, a premium pricing strategy may be more effective for products that offer exceptional quality or exclusive features, while a discount or value pricing strategy may be more suitable for products that are more commonplace or easily replicated. Ultimately, the key to successful pricing is finding the right balance between profitability and customer satisfaction, while remaining competitive in the marketplace. Pricing strategy. Your pricing strategy should consider the potential for future discounts. Stores can rarely sell their entire inventory at full price, most need to mark down at least some products. The longer inventory sits on the shelf, the more money it costs you, both in terms of storage and opportunity cost. It's better to mark down older items. That way, you can use the cash to buy some new, fresh inventory. The most common use of Keystone pricing is when a retailer brings a new product to its shelves. Without historical pricing data on the item, it's hard to know the ideal sales price you should launch with. That's where Keystone pricing comes in. By doubling the wholesale cost and setting your initial sale price at that level, you can generally get some kind of profit margin, while gathering data on how customers reacted to the initial price. This is where having a dedicated price testing framework is a powerful asset. If you find that customers aren't buying at the markup level, You can use markdowns and discounts until the selling price is more in line with customer expectations. Likewise, if your sales volume is extremely high at launch, you could raise the selling price to increase your margin. Of course, not all product launches are created equal. If you're selling a big-ticket item with low turnover and high shipping and shrinkage costs, you might end up actually eroding your margin with Keystone pricing. Commodities, low-price items, and easily substitutable items, on the other hand, might actually sit in your inventory for ages if you try to double the wholesale cost. Again, Keystone pricing isn't meant to be exact and ideal, and there are cases where it can be detrimental to your business if you apply it blindly. Consider the product itself and your competitors' prices before you use the Keystone method. Keystone pricing bears some similarities to other pricing strategies that involve taking the wholesale price of an item and raising it to achieve the desired margin. In this section, we'll look at some of those pricing strategies and compare them to Keystone pricing. It's important to remember, however, that choosing the right pricing strategy is a means to an end, which is ultimately growth and profit. There's an intimate relationship between the price of your products and your brand value. Value-based pricing is a strategy in which a retailer sets the price of an item based on its perceived value, rather than using the item's wholesale cost or historical prices as a benchmark. We often see this strategy used in luxury markets or when a product is highly differentiated from its competitive offerings. Pricing based on value means adding a markup to the item, but unlike Keystone pricing, the starting point for determining the selling price is the value it brings to the consumer. That could be far higher than the Keystone mark of doubling the wholesale price. Keystone pricing might be simple, but if your Keystone price point falls short of the true value of your product, you're cutting into your own margin. This is where a value-based pricing approach would be superior. Additionally, businesses should also conduct market research and analyze their competitors to determine where their products stand in terms of pricing. This can help them make informed decisions about whether to set their prices higher, lower, or in line with their competition. It is also important for businesses to periodically review and adjust their pricing strategy based on changes in the marketplace, customer demand, and cost structures. By regularly evaluating their pricing strategy, businesses can ensure that they remain competitive and profitable in the long run. Furthermore, businesses should communicate their pricing strategy clearly to their customers and provide transparent pricing information. This can help build trust and loyalty with customers, as well as increase sales and profitability. In summary, businesses must carefully consider various factors when developing a pricing strategy, including product features, competition, customer demand, and cost structures. By finding the right balance between profitability and customer satisfaction, businesses can ensure long-term success and growth. Keystone markup or Keystone pricing refers to selling something at double its wholesale price or its cost. In other words, a Keystone markup occurs when there is a gross margin of 100% of the cost price. Alternatively, the markup is 50% of the sale price. Any product that a retailer, for example, sells at twice the amount it paid for it, has a Keystone markup. The word keystone is a wedge-shaped piece of the crown of an arch that holds the whole structure together. It is also something on which associated things rely on for support. In biology, a keystone species is a species that has a major impact on its ecosystem. Markup. The word markup is the amount the seller adds to the cost price of a product to cover overheads and profit. Markup is also the process or result of correcting text when preparing it for printing. This article just focuses on markup's cost price meaning. When you put the two words together, markup retains its meaning, but the meaning of Keystone changes. Prices must be competitive. While a Keystone markup may sound like the seller is overpricing the product, the item's cost does not include overheads or selling costs. Depending on the industry, sellers may need to adjust the markup lower or higher. Above all, they must keep their prices competitive. When retailers buy goods and then sell them, they must include the cost of buying them plus delivery costs. Manufacturers of goods should include the cost of raw materials plus their production costs. Regularly reviewing and adjusting pricing strategies based on changes in the market and cost structures can help businesses maintain competitiveness and profitability. Good communication and transparent pricing can also enhance relationships with customers and drive sales. A pricing strategy is a method for determining the price of a product. An effective pricing strategy takes revenue, profit, consumer behavior, and business goals into account. Pricing is the act of placing a value on a business product or service. Setting the right prices for your products is a balancing act. A lower price isn't always ideal, as the product might see a healthy stream of sales without turning any profit. Similarly, when a product has a high price, a retailer may see fewer sales and price out more budget-conscious customers, losing market positioning. Ultimately, every small business owner must find and develop the right pricing strategy for their particular goals. Retailers have to consider factors like cost of production, consumer trends, revenue goals, funding options, and competitor product pricing. Even then, setting a price for a new product, or even an existing product line, isn't just pure math. In fact, that may be the most straightforward step of the process. That's because numbers behave in a logical way. Humans, on the other hand, can be way more complex. Yes, your pricing method should start with some key calculations. But you also need to take a second step that goes beyond hard data and number crunching. Pricing strategy. Whether it's the first or fifth pricing strategy you're implementing, let's look at how to create a pricing strategy that works for your business. Understand costs. To figure out your product pricing strategy, you'll need to add up the costs involved with bringing your product to market. If you order products, you have a straightforward answer of how much each unit costs you, which is your cost of goods sold. If you create products yourself, you'll need to determine the overall cost of that work. How much does a bundle of raw materials cost? How many products can you make from it? You'll also want to account for the time spent on your business. Cost of goods sold, COGS, production time, packaging, promotional materials, shipping, short-term costs like loan repayments. Identify your customers. This step is parallel to the previous one. Your objective should be not only identifying an appropriate profit margin, but also what your target market is willing to pay for the product. After all, your hard work will go to waste if you don't have potential customers. Consider the disposable income your customers have. For example, some customers may be more price sensitive when it comes to clothing, while others are happy to pay a premium price for specific products. In your value proposition, what makes your business genuinely different? To stand out among your competitors, you'll want to find the best pricing strategy to reflect the unique value you're bringing to the market. For example, direct-to-consumer mattress brand Tuft & Needle offers exceptional high-quality mattresses at an affordable price. Its pricing strategy has helped it become a known brand because it was able to fill a gap in the mattress market. Cost-plus pricing, a simple markup. Cost-plus pricing, also known as markup pricing, is the easiest way to determine the price of a product. You make the product, add a fixed percentage on top of the costs, and sell it for the total. Let's say you just started an online t-shirt business and you want to calculate the selling price for a shirt. The cost for making the t-shirt are: material costs, $5. Labor costs, $25. Shipping costs, $5. Marketing and overhead costs, $10. You could add a 35% markup on top of the $45 total it costs to make your product as the plus of cost. Pros: the upside of cost-plus pricing is that it doesn't take much to figure out. You're already tracking production costs and labor costs. All you have to do is add a percentage on top of it to set the selling price. It can provide consistent returns should all your costs remain the same. Cons: cost-plus pricing doesn't take into account market conditions such as competitor pricing or perceived customer value. Cost-plus pricing and Keystone pricing are very similar, but there's a small nuance that has to be appreciated. With cost-plus pricing, you're taking the unit cost, adding in fixed and variable costs, and then adding a markup on top of that to generate an acceptable rate of return. It's commonly used to ensure that an item earns a small margin, or at least hits a break-even point. Keystone pricing skips that middle step, simply doubling the wholesale price and hoping that accounts for any fixed and variable costs. Additionally, cost-plus pricing involves adding a markup that might end up being more than the level you'd get with Keystone pricing. What is a desirable rate of return differs for each retailer, and also has to be set with an eye on competitor pricing. Your desirable margin might end up pricing you out of the market. Prestige pricing, sometimes referred to as premium pricing, is a pricing strategy that seeks to convey a message of higher product quality and a luxury brand image by selling goods or services at an artificially higher price than comparable products. The idea behind it is using price as a signal to consumers, emphasizing the rarity, exclusivity, or high quality of the product. It's all about maximizing profit margin in market segments where people are willing to pay more for something that makes them stand out to their social circles. Just like with value-based pricing, prestige pricing isn't necessarily tied to the wholesale cost of the item. It's something to be used only in special cases where a brand's product is extremely differentiated in terms of quality or availability. If you use a Keystone price in these situations, you could be massively undercutting yourself and failing to maximize profits. Keystone pricing can still be useful in its simplicity, but only when it's used in the right contexts. Today, retailers have access to powerful price intelligence tools that allow them to do more fine-grained analyses of the market. This makes it easier to set a more ideal price when launching new lines, without losing the ease that Keystone pricing offers. Additionally, offering various pricing options such as subscription plans, volume discounts, and bundle pricing can appeal to different customer segments and provide opportunities for increased revenue. It's important for businesses to regularly analyze their pricing strategies to ensure they align with the company's goals and values. This includes evaluating the competition, assessing customer demand, and considering the impact of external factors such as economic trends or changes in regulations. Effective pricing strategies require a deep understanding of the target market and the company's unique value proposition. Regular market research and customer feedback can provide valuable insights into the pricing strategies that will be most effective for the business. Finally, it's critical for businesses to maintain transparency in their pricing strategies. Customers appreciate honesty and openness in pricing, and it can help to build trust and strengthen relationships over time. By regularly reviewing and adjusting pricing strategies and maintaining transparent communication, businesses can remain competitive and maximize profitability in the long term. If you are a retailer or just a person who is interested in e-commerce and perhaps wants to open a business in the future, then you are most likely already familiar with some pricing strategies. In this article we will talk about Keystone pricing. This is one of the simplest and most effective strategies that can suit you, whether you already have a developed business, or you're at the beginning of your journey. We will analyze the pros and cons, talk about how to use this strategy correctly, give examples, and compare it with other pricing strategies. As the name of this pricing strategy suggests, competitive pricing refers to using competitors' pricing data as a benchmark and consciously pricing your products below theirs. This tactic is usually driven by the product value. For example, in industries with highly similar products where price is the only differentiator and you rely on price to win customers. This strategy can be effective if you can negotiate a lower cost per unit from your suppliers while cutting costs and actively promoting your special pricing. Cons: this strategy can be difficult to sustain when you're a smaller retailer. Lower prices mean lower profit margins, so you'll have to sell a higher volume than your competitors. And depending on the products you're selling, customers may not always reach for the lowest priced item on a shelf. For other products where an apples-to-apples comparison isn't easily discernible, there's a reduced need to enter into price wars. Leaning on brand appeal and focusing on a target customer segment alleviates the need to rely on competitor pricing. Value-based pricing: customers' perceived value of a product. Value-based pricing refers to setting a price based on how much the customer believes a product or service is worth. It's an outward approach that takes your target market's wants and needs into play. It's different from cost-plus pricing, which takes the cost of products into its pricing calculation. Companies that sell unique or highly valuable products are better positioned to benefit from value-based pricing compared to ones that sell standardized, commodity items. Customers care more about the perceived value of products, for example, how they enhance self-image, and are willing to pay more for them. Some general requirements for using value-based pricing include a solid brand, high-quality in-demand products, creative marketing strategies, good rapport with customers, stellar track record. Value-based pricing is common in markets where a product enhances a customer's self-image or offers a unique life experience. For example, people normally assign high worth to luxury brands like Gucci or Rolls-Royce. This gives them the opportunity to apply value-based pricing to an item's price. Companies must have a product or service that's different from competitors. Pros: value-based pricing lets you command higher price points for your items. Art, fashion, collectibles, and other luxury items often perform well with this pricing scheme. It also pushes you to create innovative products that resonate with your target market and increase brand value. Cons: it's challenging to justify the added value for commodity products. You need to have a special product to apply value-based pricing. Perceived value is subjective and is influenced by many cultural, social, and economic factors that are out of your control. There's no exact science for seeing a value-based price, so the price is often harder to set. As an AI language model, I do not have opinions, but I can provide you with additional information. Price transparency is especially important in today's digital marketplace, where customers can easily compare prices online. Being upfront about pricing can help build credibility and trust with customers, and may even set your business apart from competitors who are not as transparent. Additionally, offering flexible payment options such as installment plans or financing can make expensive products or services more accessible to customers, potentially increasing sales and revenue. Overall, a well-thought-out pricing strategy can be a significant factor in driving the success and growth of a business. Price skimming: higher, short-term profits. A price skimming strategy refers to when an e-commerce business charges the highest initial price that customers will pay, then lowers it over time. As demand from the first customers is satisfied and more competitors enter the market, the business can lower prices to attract a new, more price-conscious customer base. The goal is to drive more revenue while demand is high and competition is low. Apple uses this pricing model to cover the costs of developing a new product, like the iPhone. There are enough prospective buyers that will buy the new product at a high price. The high price doesn't attract competitors. Lowering the price only has a small impact on profitability and reducing unit costs. The high price is seen as exclusive and high quality. Price skimming also works when there is product scarcity. For example, high-in-demand low-supply products can be priced higher, and as supply catches up, prices drop. Pros: price skimming can lead to high short-term profits when launching a new, innovative product. If you have a prestigious brand image, skimming also helps maintain it and attract loyal customers that want to be the first to get access/have an exclusive experience. Cons: price skimming isn't the best strategy in crowded markets unless you have some truly incredible features no other brand can mimic. It also attracts competition and can bother early adopters if you slash the price too soon or too much after launch. However, it is important to note that price transparency may not be feasible for all businesses. Some industries may have complex pricing structures, such as the healthcare industry, where the costs of medical procedures can vary depending on a variety of factors. In such cases, businesses may need to provide clear explanations of why pricing is structured the way it is, in order to help customers understand and feel comfortable with the costs involved. It is also worth considering that price transparency may not always be the most effective strategy for every business. In some cases, businesses may benefit from offering higher prices for a perceived higher value, such as luxury or premium products. It ultimately depends on the individual business and its unique goals and target market. They should also be transparent about their pricing policies and communicate them clearly to customers to foster a positive relationship and build a loyal customer base. By doing so, businesses can create a reputation for themselves as trustworthy and credible, which can lead to long-term success and growth. Transparency in pricing creates an atmosphere of trust, which is essential in building a loyal customer base. Businesses that communicate their pricing policies and fees clearly and openly are seen as more trustworthy and reliable. Customers appreciate honesty and openness, and it encourages them to continue doing business with the company. When pricing is not transparent, it leads to customer frustration and can cause them to look elsewhere for products or services. Transparent pricing policies also eliminate any confusion about pricing, which can lead to customer satisfaction. Customers want to know what they're paying for, and this can be achieved by providing transparent pricing policies. When customers know exactly what they are paying for, they are more likely to trust the business and feel comfortable making repeat purchases. In conclusion, transparency in pricing is critical in building a brand that is trustworthy and reliable. By being clear and open about pricing policies, businesses can foster a positive relationship and build a loyal customer base. This, in turn, can lead to long-term success and growth for businesses. Thank you for watching the video and subscribe the channel.